Welcome back. The topic for the day is we have already gone through the concepts of the balanced scorecard. For those of you who have not watched that video, the link of the same is given above. I request you to watch the same and then come and attend this class. So what is a balanced scorecard? Balanced scorecard is a performance metric to evaluate whether your organization is working efficiently. Now, Fitzgerald and Moons model is also a performance metric. That is also a model which tries to evaluate whether the organization is working efficiently. So what is the principal difference between the two? Fitzgerald and Moons model was specifically designed to suit the service sector. What do you mean by service sector? Where there is no manufacturing process that is taking place, like the hotel industry, the airlines, the car rentals, or any other services. So basically, it's an evolution of the balanced scorecard to suit the service sector. Let's get to know the concepts better. The Fitzgerald and Moon building block model is also a performance metric to identify, improve, and control the various business functions, mainly of the service sector. In this model, there are basically three building blocks, or the areas where focus is required for the organization's success. So what are the three building blocks? The first building block is dimensions. The second one is standards, and the third one is the rewards. Now let's get to understand the meaning of each building block. The dimensions is nothing but the business goals. It could also be termed as the CSF. What do you mean by CSF? The critical success factors. So whenever you think about dimensions, just think about the goals of the organization. And what do you mean by standards? Standards are the targets, also known as the key performance indicator. And what is the third building block? Third building block is the rewards. What do you mean by rewards? Rewards are the motivators for the employees to work towards the standards set. Now, in order to have a quick understanding of these building blocks, I'll give you a very simple example. Now, what is your goal? Your goal is to clear the ACCA exam, correct? And what is your target? Your target is to get a minimum of 50% in all the subjects. So whenever you're giving a number, it is a target. And what is your reward? Or what is your motivator? Is a handsome salary that you will be getting at a later point of time, correct? That's your motivator. Just like that, any business will have goals. And in order to achieve these goals, they have to set the standards or they have to set the targets. And employees will not work for the targets just like that. We will have to give them rewards. And these rewards should not be peanuts. If you give peanuts, they will not work for it. It will not motivate them. So the rewards should be such that they will work towards achieving the targets. Now let's go a little more in depth. So let's first start with dimensions. What were dimensions? Dimensions are the goals or the critical success factors of the organization. So the first goal is financial performance. What do you mean by financial performance? Financial performance is the goal that deals with the numbers or the dollar amount. Whether the company is achieving good profits, whether the company is giving good returns to the shareholders. So anything that deals with the numbers or the dollar amount, it comes under the financial performance goal. The second goal is competitive. Is the company competitive? Is it achieving a higher market share than it achieved in the previous year? Or is its market share reducing? Is it able to face the competition? Now, these two goals are together known as results. Why is it known as results? Because that's the end product of our actions. And what are those actions that we have to take to achieve these results? That is to have a good financial performance and to be really competitive in the market. Now, those actions that we take to achieve the results are known as determinants. Now, these determinants are grouped into four. And an easy method to remember these determinants are, we are asking four really interesting questions to the company. And the first question that you should ask the company is starting with F. Are you flexible? A company has to be flexible regarding three aspects. One is regarding the sales volume. That is, if the demand suddenly increases, they should immediately be flexible to adjust for the extra demand. Suppose you are running a hotel. Okay. Suppose all of a sudden many customers come in. So immediately you should be flexible enough to accommodate that extra customers. There should be a sufficient number of temporary staff to cater to this extra demand. That is the meaning of flexibility regarding the sales volume. Now, flexibility regarding delivery speeds. Here again, if you're running a hotel business and a customer comes to your restaurant and say that, I have a meeting in 10 minutes time. So can you give the food as fast as possible? And if you say the normal time that we take to deliver the food is 20 minutes, that customer will immediately walk off. So you should give specific emphasis to such kind of customers who insist on the delivery speed. Immediately, you should be flexible enough to accommodate him and provide speedy delivery of your service. And regarding the third one is job specification. Now we will take the very same example of the hotel business. Suppose you are providing buffet breakfast. So in the buffet, there are only boiled eggs, hard boiled eggs. So suppose a customer comes and tells you, my son doesn't like hard boiled eggs. Is it possible to give a fried egg? So if you say fried egg, that is not there in the buffet. You have to be satisfied with whatever is there in the buffet. We will not take any extra orders. So what does the customer think? Such a small variation in the order can't be accommodated by you. You are not flexible enough to meet the job specification, which means that you will lose the customer in the future. So one of the critical factors for your success is flexibility in your service. Now, moving to the next determinant. So we have asked the first question starting with F. Now coming to the second question starting with R. And the question is, are you utilizing your resources efficiently? Now, there are mainly two types of resources. One is the human resources and the other one are the physical assets. Now, what we are trying to find out is whether these resources are being efficiently utilized. Say, for example, you are running an accounting firm. In accounting firm, humans are an important resource. So only if you are utilizing the humans or the employees efficiently, your costs will be under control. Or if people are remaining idle and they are not working properly, then definitely your work will not get done and you will have to pay salary to these people. So it is very important that these human resources work efficiently. And regarding the physical assets, now suppose you are running a delivery service company. You should ensure that the goods are delivered at the proper time. If you do not have sufficient number of employees to do the delivery job, or if you do not have sufficient number of vehicles to do the delivery job, then definitely your business will be adversely affected. So the assets, whether it is human or whether it is physical assets, play an important role in the success of your business. So that is the meaning of resource utilization. You should ensure that the human resources and the assets are adequate and these resources are efficiently utilized in your business. Now moving to the next determinant. Now you know that the next determinant, the starting letter is I. So what is a question that you have to ask to the company? The question that you have to ask to the company is whether you are innovating. Innovation can take place either as a process or a product. Now, as an example of a process, if you are employing a new software and it is so user-friendly that you're getting a lot of customers through online booking, then that is innovation of a process. The second innovation can take place as a product. Now, a lot of product innovations has happened in the service sector. As an example, we could say with the coming of Uber, the car rental business has been hard hit because it's very easy to tap an app rather than call a taxi for hire. And with the coming of the OTT platforms, we are not going to the movie theaters, which means that movie theaters have also been hard hit. So innovation is inevitable in the service sector. So if you have to be in the rat race, then you should definitely innovate. And as I said, innovation can either be for a process, that is a new software, or it could be an updated product, which is much better than your competitor. Now coming to the last and the final determinant, the determinant starting with the letter Q. What is the question that you have to ask the company? This is one of the most important questions, and that is regarding the quality of your service. If the quality is bad, then no matter whatever you do, you will not get any customers. Now, why are you listening to my lecture? Because you feel that the quality of the service is good. Now, if some other lecturer comes and gives a much better lecture, then you will definitely switch to the next lecturer, right? This is the same thing that happens in business also. If your competitor provides a much better service, then you will lose all your customers. So the quality of your service is of utmost importance to be successful in your business. So we are finally done with the first building block, that is the dimensions block. So what are the 6 goals that an organization should pursue to ensure its success? They have to give emphasis on the financial performance. They should be competitive. That is, they should have a fair market share. They should be flexible. They should utilize their resources efficiently. They should give emphasis on innovation. And finally, the quality of service should be the best. If all these goals are taken care of, then there emerges a successful business. Now, in order to achieve these goals, the company has to set targets for the employees. This is where the second building block comes into the picture, the building block named as standards. And what are standards? Standards are nothing but targets or the key performance indicators. That is, a target has to be fixed for each of these 6 goals. Only then the employees will work towards achieving these goals. Now, coming to the first goal, that is financial performance. Now, how do you measure the financial performance? We can measure financial performance by looking into the profitability of the company. Now, in profitability, you can choose any profit ratio. It can be the gross profit ratio. It can be the net profit ratio. It can be the operating profit ratio. So it is left to the company to decide what it should achieve. As an example, we could say for measuring profitability, we can take the net profit ratio. And how do you fix a target? If you fix the target of the net profit ratio, say at 20%, that is, the employees should work to achieve a net profit ratio of 20%, then it becomes a standard or it becomes a target. So whenever you are allotting a number to a measure, then it becomes a standard or a target. Now, we could also measure the financial performance by looking into the liquidity of the company. Now, what do you mean by liquidity? Liquidity in simple terms means, do you have the cash when you need it? Now, in the short term, when do you need cash? When we have to pay for the current liabilities. If a creditor comes to you and tells you that the money is due, then if you tell him that, I don't have the money, so please come after a few days, then it means that you have liquidity problems. And if this liquidity problem continues for a long time, then ultimately the creditor will say, I'm not going to sell the raw materials to you because you're simply not paying up at the right time. So liquidity is something that the company has to focus on. And how do you measure this liquidity? There are many ratios which can be calculated to evaluate the liquidity of the company. As an example, we could say the current ratio is a measure of liquidity. Now, what do you mean by current ratio? Current ratio is current assets divided by current liabilities. The ideal ratio is 2:1. That is, for each dollar of current liability, you need $2 of current assets. But it varies depending on the industry. Now, suppose if the situation is like this, your current assets is worth just $100 and you have current liabilities to the tune of $200. So what is the current ratio? It's just 0.5. You know what will happen? If the creditor comes and asks you $200, then you have current assets worth only $100. What do you mean by current assets? Current assets examples are cash, debtors, etc. So you collect $100 from the debtors and you have to pay $200 to the creditors. Can you make payment? No, you will have to sell your fixed assets if you have to make payment to the creditors, which means that you have liquidity problems. So at any cost, your current ratio can never be less than 1. That is the numerator, which is the current assets, should never be less than the denominator, which is the current liabilities. Only then the ratio will be greater than or equal to 1. Now, I'm not going in depth into the other ratios because that will be separately covered in ratio analysis. Now, we know that for any measure, we have to fix a target. So for the current ratio, the company should fix a target. The current ratio could be fixed as 2:1, or it could be fixed at 1.5:1, depending on the nature of the business. Now, the third measure of evaluating the financial performance is by evaluating the risk that the company is taking. And what is the ratio for evaluating the risk? One of the ratio for evaluating the risk is the debt equity ratio. That is how much of the funds are borrowed and how much is our own funds. Own funds is the equity and debt funds is the amount that we have borrowed from outside. Now we are taking a heavy risk if we are borrowing the funds from outside, because the interest payment and the repayment of the debt is compulsory. As far as the equity is concerned, we are not taking a big risk. Why? Because we don't need to repay the equity amount and it is not compulsory to pay dividend on equity. So whenever the debt rises, we are taking a heavy risk. So the ideal debt equity ratio is 2:1. But again, it can vary depending on the industry. So we have completed fixing the targets for measuring the first goal. What was our first goal? Evaluating the financial performance. Now moving to the second goal. What is the second goal? We should be competitive in the market. And how do you measure our competitiveness? We can measure our competitiveness by calculating our market share. So we could always fix the target for the market share. Maybe the target could be fixed at, say, 30%. So the managers should work for achieving a 30% market share. Now, moving to the next goal, that is flexibility. Now, how do we measure whether we are flexible or not? Now, one of the measures for measuring flexibility is by evaluating the delivery time. Are we taking more time than what is required? So here again, we have to fix targets for the delivery time. Another measure for evaluating our flexibility is by looking into the number of temporary staff. And why are we looking into the number of temporary staff? It just gives an indication as to our preparedness to handle extra demand. Now coming to the next goal. What is our next goal? Whether the resources are being properly utilized. Now, one of the measures to evaluate the resource utilization is by looking into the productivity of the assets or the employees. Now, whenever you hear the word productivity, always think about the output to input ratio. Now, we could have productivity for either the employees or for the assets. Now, if it is for employees, then we could calculate the billable hours divided by the total man hours. Now, what do you mean by billable hours divided by total man hours? Now, if you're working in a big four, you will have to fill in the timesheets. What do you mean by timesheets? How you have utilized your working time and how much of it is billable towards the client. Suppose you are working for a total of 200 hours. And the number of hours for which you can bill to the customer is just 100 hours, which means that your productivity is just 50%. The resource is not being fully utilized. You can't have a 50% non-billable hours. So basically, you're trying to find out the output to the input ratio. Now, another ratio that you could calculate is the sales value divided by the total man hours. So all that we have done is we have just changed the numerator from billable hours to the sales value. So what are we getting? The sales value generated per hour. Now, if you have sales executives working for a company, this ratio is ideal. That is, what is the sales value generated per hour? And if it meets the target, yes, well and good. If not, we have to either train the employees or we have to find a replacement for him. Now, another ratio could be, you could also calculate the profit per hour. So it is only a combination of different output to input ratio, because output can either be in hours, that is billable hours, or it could be sales value, or it could be the profit. Now, instead of total man hours, we could also have number of employees. So what will we get? We will get the sales value per employee, or we will get the profit per employee. So that could also be fixed as a target ratio. So in short, just put in mind that it's an output to an input ratio. Now, this was with respect to employees. Now, we could calculate the productivity of assets also. And what are the ratios that we usually calculate? We could calculate the output divided by the total machine hours. Now, suppose you are into the business of making cakes. Suppose in your oven, you can make 20 cakes per hour. Now, suppose the actual output divided by the total machine hours comes to only 10 cakes per hour. Then immediately you have to understand that the oven is not being fully utilized. Underutilization of resources. Now we will take the case of some other business. Say you are into the business of delivering parcels. So you will have to calculate the output per delivery van. Suppose in a delivery van, you can hold 20 parcels. And if only 10 parcels are being transported each time, that is, you're making 2 trips instead of 1 single trip, then again, there is an underutilization of resources. Now coming to the next goal, that is innovations. So what could be the measure? The measure could be the number of innovations done, or it could be the sales value which is generated for each new product. And the last goal is relating to the quality. And what could be the measure? It could be the customer retention rate. Suppose we had 100 customers last year, and this year only 80 customers have returned to us, which means that the customer retention rate has reduced. This could be an indication of the quality of our service. Or you could calculate the customer complaints percentage. What do you mean by customer complaints percentage? It means that the number of complaints divided by the number of customers. We could fix a percentage for the complaint percentage. If the complaint percentage exceeds a certain standard, then we have to investigate the reasons for the same. Now, another target that could be fixed is the customer service score. We could ask the customers to rate our service from 1 to 10, and we could fix a target for that. That is, customer service score should not be below 8. So that will be the target. So now we have gone through the various standards or the targets that can be fixed for achieving all these 6 goals. Now there are certain properties of a good standard. Let's take a look at those. So the first property is equity. Standards should apply equally to everyone in the organization. So it should not be that the standards are meant for a certain category of employees and not for certain other categories of employees. It should not be like that. The standards should apply to everyone in the organization. Now, the second property of a good standard is ownership. For achieving the measures should feel they had some involvement in setting them. The people who are supposed to achieve these targets, we should consult with them, and then only we should fix the targets. So when they are allowed to participate, they will have the ownership of that target. So they will feel like achieving it. If you just impose a particular target on a person, then they will not feel comfortable. So basically, ownership is another property of a good standard. And the third property of a good standard is achievable. Targets should be realistic so as to avoid demotivating people. You should not set a very high target that employees are unable to achieve those targets. It should not be demotivating. It should be fairly challenging, but it should be achievable also. So that's it about the second building block, namely standards. Now we will go to the third and the last building block, that is the rewards. Rewards are the motivators to the employees to achieve these targets. Now, these people should be motivated. Now, how can you create a reward such that the employees will work towards achieving these targets? Now, as an example, we could say, we could give reward points for achieving the targets, and which is again linked to the bonus. Suppose if you can achieve a market share of 30%, then you get a reward point of 1. If you deliver the goods on time, again, you get a reward point of 1. If the number of innovations exceeds, say, 5, then you get a reward point of 1. Then all these reward points are added together, and it is based on that you get a bonus. So definitely we will work towards achieving the targets, right? So the reward should be so created in such a way that it will motivate the employees to achieve the targets. Another example is profit-linked bonuses. Now, suppose if the net profit ratio, the target is 20%. And if we tell to the manager, if you can achieve a net profit of 20%, then you get 1% of it. Then definitely he will work towards achieving that, right? So always the reward should be created in such a way that the people will work towards achieving the targets. So the properties of good rewards are, there should be clarity. Rewards should be clear. It should not be vague. The employees should know exactly what their reward is if they achieve the target. And it should be motivating. Rewards should encourage people to meet the organization's goals. And controllability. Rewards should be linked to controllable factors, that is related to their areas of responsibility. Now, regarding the controllable factors, I'll give you an example. Suppose you are working as the production manager of a company. So only the production department is under your control, right? Now, if you are told that you will be given a bonus of 1% if the net profit ratio achieved is 20%. So what will you think? Net profit ratio of 20%. What have I got to do with the net profit ratio? Those are things which are beyond my control because selling price is not under my control. The number of units that are sold are not under my control. The only thing under my control is the production department. So basically, you will not work for achieving a net profit percentage of 20% simply because it's not under your control. But if the management comes and tells you, you are going to get a bonus of $50,000 if there are 0 defects in the production process, then will you work for it? Definitely, because that's under your control. So you will work towards achieving that goal only for those things which are under your control. So that's the last feature of a good reward, controllability. The rewards should be linked to controllable factors, that is related to their area of responsibility. Now let's look into the advantages and disadvantages of the Fitzgerald and the Moons model. So just like the balanced scorecard, even in the Fitzgerald and Moons model, the FPI and the NFPI are both considered. What do you mean by FPI and NFPI? FPI are the financial performance indicators and the NFPI are the non-financial performance indicators. Financial performance indicators are basically the financial performance evaluation, the profitability, the risk, the liquidity by calculating all those ratios that is relating to the financial performance. And what are the NFPIs, the non-financial performance indicators? Anything which does not deal with the dollar amount. That is, you're looking into the quality, you're looking into the flexibility, the resource utilization, innovation, all those are NFPIs. Okay. In this model, we are considering both. So basically, you're getting a complete picture of the organization. Now, the second advantage is differentiates between results and determinants. If you recollect what we studied in the dimensions, there were totally 6 dimensions, right? The first 2 were relating to the financial performance and the competitiveness. Those were the results. And what were the determinants? The 4 really interesting questions: flexibility, resource utilization, innovation, and quality. So those were the determinants. So basically, it differentiates between the results and the determinants. Determinants are basically the factors that contributes towards the results. So in the Fitzgerald and the Moons model, we are clear as to what is a result and what are the actions that have been taken to achieve those results. And the third advantage is targets are fair and achievable. Now, we have seen in the properties of a good standard that there should be equity, it should be achievable. So that is what is mentioned as the third advantage. And the fourth advantage is rewards act as motivators. Just now we saw that whenever you create a reward, it should be created in such a way that it motivates the employees to work towards the targets. So those were the main advantages of the Fitzgerald and Moons model. Now, going to the disadvantages, the first disadvantage is information overload. Just imagine the information overload. 6 dimensions with its respective standards, and whether all these people are achieving these targets. There are so many targets that they are pursuing. So basically, there could be an information overload. And the second disadvantage is the key factors are ignored. Now, what are the key factors that are ignored? Example, CSR. What do you mean by CSR? Corporate social responsibility. Now, you all have heard about Big Four: PwC, EY, KPMG, and Deloitte. But earlier, it was the Big Five. Who was the fifth? The fifth firm was Arthur Andersen. Where are they now? They were thrown out of business because they did not follow the corporate social responsibility. Now, every company has got a responsibility towards the society. And one of the responsibility is to be ethical. You should not cheat the society. Now, what Arthur Andersen did was they were auditing a company called Enron, and they did an accounting fraud. Now, Arthur Andersen happily signed all the audit reports, Now, if you think about the Fitzgerald and Moons model, Arthur Anderson had applied all the 6 dimensions. The first dimension, the financial performance, was extremely good. The second dimension, competitive. They were extremely competitive in the market. The third dimension, flexible. Yes, they were flexible. All their audit reports were on time and suited to the customer's interest. Resource utilization, yes, they were utilizing the manpower to the fullest possible extent. After all, you know the culture of Big Four. It is corporate slavery. They will utilize the manpower to the maximum extent. So basically, resource utilization was at its maximum. Innovation, they were using the top-class software of their times, including all the accounting tools that were the best in the industry. And as for quality, the quality was also good as far as their customers were concerned. The quality was not good only for the society. Just because they were not ethical, they were thrown out of business. So this is a huge disadvantage of the Fitzgerald and Moons model. They've completely ignored the corporate social responsibility. Now, moving to the next point, they have also ignored the risk management. The risk that the company takes should always be within its limit. As a classic example of a company which failed miserably due to improper risk management is Lehman Brothers. Now, Lehman Brothers was one of the biggest investment bankers of the US. One of the primary reasons for the failure of Lehman Brothers was their exposure to the real estate market. All their investments were dependent on the real estate market or the housing prices. So when the housing prices dropped, or when the housing bubble burst, they just collapsed miserably and they had to file for bankruptcy. So basically, it was putting all eggs in one basket. If you have a diverse portfolio, that is, you should not be dependent on only one sector, which means that you should try to reduce the risk by diversifying your portfolio. Only then you will be able to survive if that particular sector collapses. Making a long story short, risk management is of utmost importance for the survival of any organization. As far as the Fitzgerald and Moons model, they do not even mention about risk management, which is a big disadvantage. Now, coming to the next disadvantage, conflict. In order to improve the financial performance, we will have to cut our cost. But cutting costs may adversely affect the customer service. So there could be conflict between the dimensions. And the last disadvantage is increased cost. Now, whenever we have more performance measures, it means that we need more people and more time to monitor them. And definitely, this entails a lot of cost. Now, in the question, they will give the details of a company, and they usually give a good financial performance for that particular company. That is, the gross profit ratio would have improved, the return on capital employed would have improved, and you would be asked to evaluate the performance measurement system of the company, or you would be asked to evaluate the performance reporting system of the company. Please note the words system. So usually what happens is the students get misguided by the good financial performance of the company and they start to evaluate the performance of the company. In their answer, they include that the company's financial performance has improved because the gross profit ratio has improved, the return on capital employed has improved, and so on. But that is not the answer that they are expecting. They are expecting you to evaluate the system and not evaluate the performance of the company. So your answer should be, the company is being evaluated only on the basis of the financial performance indicators, that is the FPI. As per the Fitzgerald and Moons model, there are many non-financial performance indicators like flexibility, resource utilization, innovation, and quality, which are equally important for the success of the organization, and then elaborate it in detail. And the second error that students usually make is they do not read the question carefully. Now, for questions concerning the Fitzgerald and Moons model, there will be hints given in the question as to what is the defect of the company. Sometimes they would have left out on the quality aspect, or they would have left out on the resource utilization aspect. So immediately you have to pick that point point and state it in your answer. That is, a company is not being evaluated for the resource utilization or the quality. So it is very, very important that you read the question carefully, because half of the answers you can get from the question itself. Now let's have a quick summary before we wind up.